All right, welcome to Random Rogers Big Picture for the week of October 15th, I guess it is now. The year is just flying by. I'm going to go over four things this week. One, patience. Two, no free lunch. Three, a new blog that came in to my email, and the Wisdom Tree sector funds. First, starting with patience. Let me talk a little bit about the action lately in energy and basic materials. Both areas I've been heavy for a while. Both caused me to lag during the third quarter, and both have been coming back nicely. The reason why I outline this with the word patience is to talk about that if those sectors continue to come back and retrace a big chunk of what they declined in the third quarter, then hopefully for me that will mean that the client portfolios will retrace some of what they lost. And here the point is about patience. These are big picture themes that I would expect to play out over a long period of several years. If it turns out that I'm right, well, okay, it makes sense to think that there are going to be some big corrections along the way. And if it turns out that I'm wrong, well, then I'll just be an idiot about it, and that'll be that. But as you manage your own portfolio, I imagine you've got some themes that to you are big macro themes that you think will take a while to play out and that you think will make you quite a bit of money. That's where I am with energy and materials over the longer term, but that there could be, whatever the magnitude of this correction was or turns out to be, I imagine, pretending for a second that I'm actually right about this, that there'll be another correction just like the one of this third quarter again over in the next couple of years. There may be a couple of them, something to keep in mind, but fundamentally I didn't see a reason to give up on the theme. Hopefully that makes sense the way I'm saying it. No free lunch. I got an email from someone asking, he says that a lot of stocks are going to be, or a lot of companies rather, are going to be declaring large special dividends to try and reduce their cash positions, and he wanted to know if selling them short might yield a quick and automatic profit. At least that's how I read the email. The short answer is no, there is no free lunch on that sort of thing. When you're short a stock, you have to pay the dividend. I think probably most folks know that, but in case you don't, and a little bigger picture, you'll come across things that occasionally, mostly in the options market, but occasionally appear to be a free lunch where it's just giving money away. Whether you can figure it out or not, it's not giving away free money. And believe me, you will not figure out why all of them are wrong. However, trust me, you're not going to get free money from some sort of dividend play, some sort of option arbitrage, some sort of, whatever. There's more to it than what it appears, and let's just leave it at that. I got an email. I get a lot of these, and there's just no way I can reply to all of them. There's no way I can put them all on my blog. I imagine I'm not unique in this regard. But one, I'll give you the address. I'm not, saying that you should read this blog. I'm not saying that you should not. I'm not saying that you should do the strategy that they're talking about. I'm not saying that you should, whatever. It's just to make a point about, taking in different strategies. This specific strategy, doesn't mean anything to me. But the website is crowderinvestments.com/blog. Crowder is spelled Crowder. They do some, short-term option stuff. It looks like it's a form of very short-term momentum. That's a mischaracterization, I'm sorry, to the guy who runs the blog. His name is Andrew Crowder. You can go ahead and read for yourself and decide for yourself whether you care about the strategy. Narrowly speaking, the strategy I don't care about. But bigger picture, that in the guise of what we've been talking about lately, generally speaking, having a low beta portfolio with capturing most of the market's return with just a narrow slice of the volatility. Okay, in that sort of a world, having, 3, 4, 5% of your portfolio in some sort of strategy that is quite aggressive, that chases a lot of heat, is not a crazy idea. I don't know that this is the idea. It may be. I don't know. The performance page looks pretty damn good. I'll say that. It doesn't mean that you're not taking a ton of risk, but it's just kind of a big picture concept. If you want to get very conservative with 97% of your portfolio and go hog wild with 3%, it's just something to think about. Your risk, your 3% never going to go to zero, at least with what he's doing. Just kind of a different way to think about your portfolio. If that 3% doubles, think about it. You're getting 3% by just exposing 3% of your account to something crazy. If it does poorly, you're not hurting yourself financially. Think more conceptually, not narrow strategy that he's doing. One last thing is the Wisdom Tree sector, foreign sector ETFs. They listed today. I put that on the blog. Then I checked back to see if there might be more information, and sure enough, there was. There was information on the funds themselves, not the underlying indices. So there's no dividend yield information, just the top 10 holdings is about all I have. And so far the holdings are a little weird. I'll give you you can go to the wisdomtree.com and see this for yourself. But with a lot of them, they're huge positions in a handful of stocks. I'm looking first at the telecom group. Vodafone is almost 10%. France Telecom, 9.5%. Deutsche Telekom, 7.7%. China Mobile, which is an interesting name that one or two clients own, 6.09%. Telefonica, which most clients own, 5.7%. It's kind of interesting construction, but it's a little different than what the other funds look like. I'm going to write about these in more detail when there is more information available. Also, I was a little disappointed in what I think I'm seeing with the financial fund. HSBC 7%, Royal Bank of Scotland 3%, Lloyds 3%, Barclays, which is a client holding 3%. It's mostly Europe. I'm very surprised that we're not seeing Australia in there, and it doesn't have all the holdings. For now, it's just the top 10, and there's no Australian exposure. I think it has to do with what their methodology is, the total dollar value of the dividend from the entire company. So all of these companies are much bigger than the Aussie banks. That might be what the issue is. And the last one that I'm interested in, Basic Materials. Again, kind of lopsided. Anglo American's the largest holding at 9%. I own that one personally. A few clients own it as well. BHP Billiton is big in the fund. Rio Tinto is big in the fund. Kind of names that you might expect to see. Hopefully we'll know a little bit more when we get more information. I'd be curious to see what these things yield. But with regard to the financials, the concept is pretty good, but if I were to own this as a to represent the financial sector in my portfolio, I would want to layer in something that captured Australia one way or another. They've got another fund that I've written about a few times before. It's an ex-Japan Asia fund. It's 87% in Australia, I believe. That might be one to check out to kind of supplement this. But we'll see more shortly. And that's it for this week.